Tony's there. All right, we're ready to go. All right, Monday morning. We are going to get into the second half of the checklist. So I hope that any of you that are new have downloaded that. Please let us know if you haven't discovered it. Lower right-hand corner of Omnovia there. Get that up. Get a copy of it. Print it out. Have it in front of you. We are going to get rolling here, starting with ads, right? Checklist part 2 today. Some trade reviews. Tony's got something for you. And yeah, let's get started here. Ads. How to add to your position. Now, ads are mandatory, right, on your checklist. You've got 2 ads that you need to put in there. And this is going to happen. Well, the first pullback is one of them. What is a healthy pullback? First thing you need is a leg up. You need some 3 pushes. You need a significant move, maybe a significant elephant bar. And then you need a correction of not more than 50 to 65%, right? That's what a healthy pullback looks like, right? You don't want to have solid bars of the wrong color in there. You prefer anyway. And, 3 to 8 bars is usually the best here. Often, it'll be between 3 and 5. Once it starts getting too many, something is wrong, right? If you get too many, it turns into a power trend that's just going against you. So what I'm describing is what a decent pullback looks like, right? Initially, you want, a solid move up. And ideally, the pullback is going to have smaller bars, right, indicating a controlled pullback, right, a slowing down of momentum. And ideally, this will trigger the buy above the 50% area, right? Right. Where it triggers is the important part. And, like we discussed, the ones that don't look as good would look a little different, right? You've got your first leg up. It could be multiple bars, for example. But the ones that might be problematic might start like this, right? When they start like that, they still work. You still have to do your ads, but when they're getting way down here, now you say something is wrong with the play, and you still have to do your ad, but what would happen is you still do your ad, but your expectations may change, right? You might say maybe a new high is not as likely. But we'll get into the examples as we keep moving, right? So let's move on to the next slide here, right? Your ads are mandatory, and you want your first red bar ignored, green bar ignored, and you want your first pullback. Both of them you've got to add there. Preferably, you've taken your initial entry and you've already taken your first profits, right? So if you've taken your first profits, adding is not going to screw up your risk parameters. If you're adding here and here before you've taken your first profits, so let's say this is your entry and you haven't taken profits yet, and you have a max loss per trade stop down here, these ads will suddenly jam your max loss per trade. And if suddenly this max loss per trade gets into places that can cause a problem. Now you've probably added too much, right? So you need to be aware of what this does to your average price and what it does to your stop. Once you're getting into profitable territory, you can take this ad and you might say, well, I have to adjust my stop to an event stop, meaning it was max loss per trade down below here. But if I'm going to add, now my stop has to become an event stop. And this is all kind of assuming that you have not taken any profits yet. But you have to be aware that this can totally change. Can you guys see that? Max loss per trade. It lies way down below there until something happens where now your max loss per trade is going to move inside that 200 MA zone, right? If your 200's down here. When it gets down there, you can no longer wait that long. So you may have to move your stop up to an event stop. That's why it's preferable that you've got, 3 pushes and you've taken profits first, but you don't always get that, right? And you still may have to add. And sometimes all you get is a pullback first, right? You enter here, and the first thing it does is pull back. Now you still have to add, right? You still have to take your add when it takes off, and you still can get your new high profit take. You can do other ads later in the trend, but I'm going to suggest you be very sparse with that. Don't just hit every single pullback, because how many pullbacks does a trend tend to have? I mean, it may give you 3. If you're really lucky, it'd be more than that. And oftentimes, all you get is one new high, and the trend is done for the day, or the nature of the stock has changed, right? Is all of this clear to people? You have a red bar ignored, and you have a pullback, and the first ones you have to play, right? Both of them. But being aware of what it does to your risk parameters. And if it's too much risk, you can't take it, right? So we're going to see that more in the examples, and you're going to see that Jan's going to talk about that in a lot of the journals that come up, right? Oh, let's see. Carl's saying, can you explain again if you had not yet taken profits? Can you add? Yes, you can add, definitely. Like in this example, right? Here's your initial entry. Here's your first red bar ignored. Certainly you can add. And it's just a one lot add, right? And then here's a pullback, and here's another one lot add. But your stop has not moved yet. It will affect risk. And so you have to be careful that even if, let's even assume that you're starting with an event stop here. If you start with an event stop and here's your entry, you still have an amount that's your max loss per trade. Do you guys understand this? That still, even after you add, max loss per trade is the most you will. So let's say it's $100, right? And this is 30 cents here, right? The size of this elephant bar is 30 cents. And you take 2 lots, right? So you're in 2 lots right here. You've risked $60. And you add here. And your max loss is 100, right? If you haven't moved this stop, you have to make sure that adding this to the size of your position is not going to make this more than $100 if that's your max loss per trade. Does that make sense, Carl? And what that would do is that would that would preclude your ability to add on this one. You would say, I can't add on this one. Once this makes a new high and you take some profits, now maybe on a subsequent pullback you'd be allowed to, but I think you have to be careful about that. On a new high, now your stop is right here. So, I think you've taken some off and now you just let that last lot trail out. So it's best to get your, ideally you'll get your 3 pushes first, right? So what if you had an entry down here below everything? If this is your initial entry and you took profits here, maybe it'll be easier to get a couple of ads here out of it. And by the time you take some profits here, you might have a stop adjust somewhere, right? All right, Dennis is happy the sound is better. Okay, good. I'm glad this thing works. But we're going to go into all of that. Let's keep moving forward, and we'll see some examples when we start looking at some charts, right? So profit takes. That's the other thing that we need to get very clear. You want to take profits on your third push. So if you enter and the first thing it does is the stock charges away from you and you've taken let me make this clear. It's got to be 3 pushes from the correct entry. So here's your elephant bar, right? Your correct entry is above the high, and here's 1 push, here's 2 push, and on the third push you have the right to take a profit, right here. Now, this particular slide here is talking about the whale concept. The whale concept means after a pullback, whale complete is at the new high, right? We all understand this concept. We've all heard this, right? So perhaps you've already had your 3 pushes inside here. Profits have been taken maybe. You have a pullback. And at the new high, you add, right, of course. And at the new high, you can take profits. We put this slide first because it's very important that what we're after is the whale. We want to take plays where we are able to sit through the first pullback, right? Sit through the first pullback and get the first new high or new low. That's the most important part, right? Oliver wants you to be able to, and he says this over and over. He says there is no big trader that can't sit through a pullback. It's like if all you do is try to get 1 or 2 pushes, he says there's no big trader that just does that. And he says big trader because he wants you guys to be able to have big size. He wants you to be part of the buying on the way down, right? The leveling in. That's what professionals do. They're putting their orders down below. They know when a power move up has a high probability of pulling back and making new highs. So an excellent trader, right, will be buying into this power bar. Really big traders are still buying. And then they're starting above to offer their sell orders, right? They're selling, 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 selling. And as this pulls back, the real big dogs, right? They start putting their buy orders in here and a bigger one here. and a bigger one here, and a bigger one here. And then as it turns around, right, ideally, if it turns around, immediately they start selling a little bit here, right? And selling some more here, and selling some more here, and selling some more here, and they hold it, you know, and they're able to get some of the ones up here as well, right? So it's kind of thinking differently. Novices are buying here, right? And they're panic selling on the other side. It's not going the way I want. Get out, get out. And you're falling right into the buy orders of the big fish who are picking these up, right? And maybe this is where the novices are getting out and the big fish are gobbling up their shares, right? And then when this starts going again, right, the novices are already getting out. Thank goodness, I'm just barely profitable, right? Or actually they're just starting their buying, and the big fish are starting to level out of their shares, right? Right at the new high, Oliver will say right at the new high, all sorts of people, it shows up on their scanners across the planet going new highs, and a whole bunch of idiots jump in and start buying here. Meanwhile, right, the pros were buying into this pullback, right? But people get excited, new highs, and they think that's the time to actually buy. That's not how it works, right? You know, Oliver wants you to he wants you to be target shooters who can catch the turn, who can catch this place where it turns. Because, you know, it's one of our market laws, right? The second move is the big one, right? The second move is the big one. Okay, so Carl's asking, does Dr. Dan's strategy of the 1 hour break even and 2 hour trades profit doesn't apply for the open? It does. Okay, that has nothing to do with the checklist. So what Dan has a strategy that works very well. It's an excellent risk management strategy. And I don't want it to be confused with the checklist. Because think about it. I'll try and make a drawing of this. All right, here's your 200. Here's your elephant bar. Right. Maybe we get a push or two. And then we get a pullback. And then we get a new high. Now, let's take Dr. Dan's strategy. Let's say Dr. Dan got in right here. You get to 1R, but you're not allowed to take profits yet. You stop out at break even, and then you miss the whale. Was there anything wrong with this decline? Was there anything abnormal about that decline? Is there any reason to get out of that play? Exactly. So we're looking for something different here. And Dan looks for particular setups that he wants like immediate explosive follow through. And sometimes he's starting right here. I have to say he plays those VBSs and stuff like that. But we're talking about the first bar of the day, and yeah, it is a little more like scalping. He does quick money, lots of shares, throws them in, and I have to say, Oliver as well, because he's usually coaching us at the Open, he's also closer to that, right? So if you're on the black team, basically you'll see Oliver taking one push, like in the first 2 minutes, he's already taken profits. Like he's that good at it. But he's like, he's always saying, I'll tell you after the fact, but I'm not going to tell you I'm doing this because that's not what I'm teaching you guys to do. He's, and he just has a feeling for stuff that, like, we're not going to catch that quickly, right? By the way, I'm going to bring this up, and is there anybody here that would be interested in joining the black team? Okay. You guys can email Jim at iFund Traders. I would just put a little message in your just put black team in the subject and say, and I can't tell you about the conditions. All of that would be Jim. But I did. Somebody had a question, and I messaged Oliver, and he said all of you guys who are part of our coaching group are eligible to ask about that. And it is invitation only. But I think he's, it's kind of it's a small group, and if you want to send an email to Jim at iFund Traders and just say, Tyler said maybe we could do this. Look, there's definitely a cost. It's not cheap, but I don't know what that number is right now. And but I do think some of you guys are really, especially those have been here a few months. I think you'd be good candidates for that. So that's something to consider. That's something for you guys to consider. And he really doesn't open that up very often, but he does like a lot of the stuff that you guys have been doing in the mentorship group and stuff like that, and seeing your progress. And he wants to see you the next big dogs are going to be, right? So I just wanted to point that out. So anyway, let's go back to this, right? So we are looking for whale complete, right? So these are on your checklist. You've got two potential profit takes. One is 3 pushes, and the other is whale complete. This also says 30 cents. What's meant by that is it needs to have moved at least 30 cents. And I have to say, do not just take profits at 30 cents. That is not what this means. It means it has to have moved at least that much. And well, cool, Dennis. Yeah, and obviously, any of you, when you're ready, you don't have to rush into this, but you can just say, "Would you send me some more information?" That kind of a thing, and they can handle that. Also, understand that admin is really bogged down with all sorts of new people jumping in and everything, so it can take a little time for them to respond to stuff. But yes, that's it, Edward. Yep. Sorry, I got us off track. I know I kind of have a scattered brain this morning. But again, 30 cents is not so we don't want to see on your journals it was 30 cents and that's why I took profits. That's not a reason. It just needs to have gone at least that far. And honestly, on the trades I take, if it's not at least 50 cents, I don't even want to look at it. I'm not interested. Like most of the stocks you trade these days move so much further than that and have an average true range of $2 or more. So yeah. So Aka, yes, just put black team in the subject and email Jim at iFund Traders and just say, hey, I'd be interested in joining and that kind of thing. Could you send me more information? And see what happens there, right? So yeah, I don't know, I don't know what their vetting process is. They just said that we were allowed to tell you guys that. So let's make sure that we don't get lost here, though, with this, right? So ultimately, our real target is this. And you can take some on the first leg, on the first move up. Like, let's say you entered here. If you get 1, 2, and if this is your third push, you're allowed to do that. Right? Do we understand that? Right? Third push, you can add, new high. These are your first, like, you can absolutely profit take at these places. And it's not to take all. It just means to take half. You can have, your own discretion on that. Maybe if you have 3 lots on your initial entry, maybe you take just 1 off. Maybe you take 2 off. I always, if I had 3 lots, I would always take 2 off because I can put both of them back on the ad, right? Depending on where the pullback happens. Victoria says, if the 30 cents comes before the third push, should we take profit? No. That's exactly what I'm explaining is no. It has to be the third push. And there are 2 push days. So there are days where stuff just isn't following through. Might be a Friday, might be during the summer. And if you say, if you're making a journal and you say, I took profits on 2 pushes because it just seemed like an inside narrow range day and nothing was moving, fair enough. That means that you were being conscious of what you were doing. You were being conscious of the lack of volatility in the market. And Oliver will say that. If any of you join the black team, you'll hear him say, it looks like today is going to be a 2-push day. And that means, you'll get your elephant bar or whatever, and you'll get your entry, you get 1 push, and then right about here is about all you're going to get before this thing reverses and, does whatever, So sometimes that's all you get, and you want to take profits on your first lot there, and then see if you get a whale complete or not. Does everybody understand the whale complete concept? We've all heard this. Is this completely new for anybody? Anybody not heard this term? Whale complete just means that after a pullback, you've reached your new high or your new low. And sometimes whale complete just means something else. And I'll explain what I mean by that. Sometimes whale complete is this. You have your initial move up followed by a collapse. Now this is an important one. If this is your next bar, you still may end up adding on the buy, but what happens to your expectations here? When this is what happens at the high, what's the probability of a new high? It's very low. But what kind of a pullback, like if a buy triggers in this particular drawing, what do you think is a likely zone? Yeah, I drew this one because we all kind of know that, like, this violent bar sends its power to the right, and so if we get a buy here, it's likely to get about here before reversing, right? So you can add, and your whale complete might be here. And this is how, especially on the black team, this is how we get out of trades that aren't working, right? We got in here. We didn't get our third push. We get a violent pullback, and we take our ad, but our whale complete is here. We got out break even. So this is how you take a trade that isn't working, and you turn it into a break even trade. You go, the violence killed the probability on this trade. My whale complete is here, right? So whale complete, we want it to be a new high, but that tends to happen when you have a healthy pullback. And sometimes you get a violent pullback that's so violent that maybe all you would get is a 30%. So if it comes back up, it may only go 30%. And then you got to add a couple of lots here. Get the quick bounce, get out, and done. So sometimes the real whale that you thought was going this way actually went this way. And that's all you're getting, right? And by using max loss per trade and using your ads wisely, you can still get out of the trade, break even. But I want you to be thinking of this, right? And if something collapses on you, it's okay to say, I'm just not going to add, and then you just take your stop, right? You can just say, this thing, I'm not going to add into a collapse, let the trade stop, and go, well, next one on my 20 trades list. That one didn't work. Do 20 trades and compare and figure out which ones work and which ones don't and what's different about them. Right? So I want to see if we have examples here. Okay. Yes. What is a push? A push needs to be, if your entry was here, it needs to be a clear, solid move. It can't be just like 2 pennies, So let's call this one 2 or 3 cents. And this one is more like, a good 10, 15 cent move, right? You need to have a decent move. And you're going to notice that if this was your first elephant bar right here, let's just draw an arrow. Let's say this is your first elephant bar, and this is your entry. The first push after the entry is this nice big clear bar, and then these other bars over here, everything inside the range of this bar, right? Everything to the right of it is not a push. So this is not a second push, right? The second push is this one that clears that range, right? That's push 2. And then this is not a push, and this is not a push, and this is push 3. You understand that? So anything that's trading inside the range is not a push. This is not a push, right? Sometimes they're consecutive, right? We love it when they're consecutive. It's very simple to count that way. But sometimes you get this, right? You get 1, 2, 3, and that's another way you can count pushes, right? And that's totally fine when you get that. You can still have a pullback inside that push, and here's your ad, right? And then we make a new high, right? Now here's an ad above a red bar ignored, so you've got 2 ads already. Your stop is adjusted, so your risk is fine. And then, this moved up here. Now here's your third push. You're allowed to take, your third push. Now, Edward's got a good question. Are we allowed to completely exit the trade on the third push, or do we have to go bar by bar and trail 8 for the last lot? Okay, we're going to get to that. This profit take number 6 on your checklist is only to take a portion, right? So it's only to take a half, no more than 2/3 of your trade. If you get a really good push, and there might be like, if in 3 bars you move an entire daily range or more, like it just explodes like some ridiculous thing you've never seen before, and I would say if it's just ridiculous, I mean something you never see, and it takes out so much that like you just can't imagine, this going any further. Then it's, if it goes to the moon in 3 bars, then yeah, it might be time to take all. But that's when like this way exceeds any expectation you could have had for the entire day, right? It's like this is more than the entire day could possibly have done, and I just got it in 6 minutes. Then you go, all right, it's time to take all. And I still would play a pullback even when I see that, right? So that's a different thing. So 3 pushes can come all in a row, or it can come separate like this, but it can't come like inside the range of another bar. So I hope that's clear. So here's an example, right? Here's your entry. Sometimes your first push happens inside your entry bar. That's a push, right? Your entry was here, but you got a nice push. This is not a push, right? This bar is not a push, but this is, and this is your third push, and you're allowed to take profits in here. So you take one off. Green takes out red. There's your add. On this massive bar, you take out the highs, you're allowed to profit take. Right? So somewhere in this bar, here's profit take 2, right? Here was profit take 1, here's profit take 2. And then you, at this point, go into a trailing method. So maybe this would be a bar by bar situation, and you would get out right here because it's kind of had a massive lift off here, and it has distance from the 20, and you would say, all right, this is enough, right? This has moved a long way. Does that make sense, guys? Any questions about that? Right? Push 1, push 2, push 3, profit take, add. You could also potentially add again here. And we'll see with the stop adjust, you could add here and you could add here with the red bar ignored. Your stop would already have moved, and then you'd be taking some off and then trailing out the rest, right? So even at new high, you're not ending the trade. You're just taking the lot that you added off, but you're still keeping one of the original 2 lots on, right? So let's say you were +2 here, right? You'd be -1. So that's going to leave you with just 1 lot left. Let's say you add here, so you're +1, which means that you're going to have 2 lots. Now up here, you're -1, right? Which means you're still going to have 1 lot left. And that's why you get out here. You understand? And how do you manage stops in this example? We're going to go over stop adjustments here. But we have a pivot stop. So if our initial stop was down here and you profit take, I would say at this point, your stop can come here, right? After that profit take, there's just no way that you should lose this entire leg, right? I think at this point, after your first profit take, you can look and see if an event stop adjust, and you go, yes, if this came back here, it would be fine. Then after the add, once we get 75%, right, we're allowed to bring the stop from here up to here. After the second profit take, now we got to get tighter, and as this moves away and away and away, we might go to bar by bar and stop out there. We're going to go through how to do that here in a couple of minutes, right? So stop adjustments. So after you've taken your first profit, so Dennis is asking, isn't it FIFO for first in, first out when you exit? Oliver wants you to think of it that way. So, in this example, one of the first two lots that was taken here is this one that's coming out, right? So one of the first two lots is coming off, but the other is staying on. There's an add here. That add is coming out up here, but one of the first two lots, one of these guys, is this one that comes out at the end, right? So one of them you just want to hang on to forever, right? One of the initial lots you take, one of the first lots that you put into the trade is going to be stop adjustments, right? It's going to sit all day, right? However long it takes for the stop adjustments to work out. Now, profit takes, one of the other lots, that's going to be your profit take lots, and one of your adds is going to be one of your profit take lots, right? Edward's asking, is there a way to control this? It seems like the last added lot is the first one. It automatic. Oh, okay. Forget what your computer says. Don't worry about which one. You know, what's the program called here? Sorry, I'm having one of those mornings. Sterling, yeah. Forget what Sterling says. Don't worry about that. It's not important, right? You want to keep in mind where you initially entered. Yeah, it does one of those last in, first out, or first in, first out. Forget about it. It doesn't matter what Sterling says, right? What matters is that you follow the checklist here. Now, these are the different stop adjustments you can do, right? We're going to go through each one of them. And you understand that one thing you could do if you have trouble with your risk amounts and all that kind of stuff, and you want to just get good at like sitting through stop adjustments, is you just enter one lot and forget the first profit take and the first new high, and you just stop adjust. Some of you, that would be a better exercise. Just say, I'm getting in on this elephant bar, and I need to follow a stop adjustment rule to get out. Oh, did you lose sound? Did I lose sound somehow? Shouldn't have lost sound. Looks like it's making noise to me. Okay. Yeah, hit the reload button if you need to. Okay. So, pivot stop, right? Moves up, pull back. When you get 75% of the way to new high, right? So at this point right here, right, can we agree that from here to here, this is about 75%. Now the stop can move from here up to here, right? 75% of the way back up. Now this stop can be adjusted. That's how that works. Then we make a new high. We pull back. We start moving up. We get about 75% of the way, and this moves up here, right? Does that make sense? That is how a pivot stop adjust works, right? Any questions about that? We're going to see a million of them in our journals, but I want people to get that bit of it. Any questions about this? Once you've made it 75%, that's when this can happen. Now, Edward's saying, is that because at the point it fails to make a new high, you want your pivot to be your stop? Okay. This is what can happen. Here's your initial move up. It triggers a buy. Your initial stop was down here. A lot of people will just jam their stop up right here. You see that? And then it'll do this. And it'll make the double dip. And then it'll go and make the new high. Only at this point can this stop come up to here. This forces you to not get all crazy about what triggers and whether or not, you know. So, we can probably find an example from today. Let me see if I can find one from stuff that's happened today. Here's one that looks like it would have stopped you out, and I haven't gone into that yet, but that's not going to be the best example. I like this here in a sense. So let's say you're in AMD and you entered here. You took some profits along the way. This isn't the best example, but maybe you took some profits. But let's say you added here and your stop is way up here for the last leg. You might have added at this point and then brought your stop here. And then you would have missed the new low. You see that? Only at this point can we bring that stop down here. Does that make sense? And I only use this as a stop because I use this as a color stop, like the green bar. And we'll get to color stops, but here's a green bar ignored, and it moved down to there. But this keeps you from being shaken out. Somebody said Met. Let's take a look at MetLife. Right? Oh, here's a good double dip as well, right? So I'm not saying this is a great short, but let's say you entered here and this is your stop up above, right? Somebody would have entered here, they would have got stopped out here, and they would have missed this whole move down, right? You're just going to get used to seeing the double dip. And what you're going to realize is this fluid move down right here. Right? Can you see it? This series of red bars. It may take some time, but eventually that resumes again to the downside. Right? And it loves to stop people out right where it gets going again. It's this, and so the question is, how do we manage the stop when the pullback is not healthy? It's the same rules, but I will say this: you may see things, Carla, that tell you that the best thing you can do is get out of the trade, right? And when you see things like that, for example, let's say you shorted this and you took profits here, and then you saw this violent move up as a pullback. You might say, I don't think, the way that this pulled up, new lows are not likely. And so you might say 50% is where you get out, And so instead of looking to stop adjust, you're looking to get out. That changes the nature of the whole thing, right? And that's a higher level, but you can't, like, this gets down here and now your stop moves from here down to here, and that's what you have to do. right? You have to, this was a violent move up, and you have to take the stop because you don't know. You don't get to know which one is going to make it all the way down here and which one doesn't. And the good thing is this, if you entered here, you got some nice profits, right? And then you added because you have to. You got down here and the stop adjusted, right? You did bring the stop adjust here. Some of us would actually have profit taken right here because we would see that this play is over, and you still have to wait and see because you just don't know, right? This made it look like maybe we are going to get that new low, right? We expected new highs here. It didn't happen. And you don't get to know which one. But the thing is, because we're doing a 20 trades checklist, right? We're trying to see how many of these whales complete. You know, how many of them make a new low and a new high? You don't know which ones are going to get there. So it doesn't matter. All that we do know is that the little stop that this made, right? You took this ad and you lost a little bit here. What happens when this doesn't stop? We get this, right? So you entered and you took profits here. You got your ad. This point, you got your stop adjust here. And a portion of it lost. And the whole trade didn't make as much money. So what? But over 20 trades, the ones that do this, even if that's 1 in 3, is going to massively take out the losses from that little bit. You see what I'm saying? Did that make sense, Carla? Did that answer your question? Is that clear to everybody? We want to be able to sit through this, even if it's scary, because sometimes it doesn't matter how scary it looked. That it becomes the most, powerful, you know. So here's a good example, right? BA, you got in here. Here's your initial stop, pull back, add, right? Here's your 75%. We are now doing a stop adjust to the pivot. That's a pivot stop adjust at 0.1 here, right? We move way up, we pull back. At 0.2, we're about 75% of the way up, and now our stop moves up to here, right? Boom. Here's a 3-bar pullback. Once we get up to about here, now our stop can adjust to 0.3, right? This is an interesting thing. I put this in here because with a stop adjust on a pivot, you need a 2-bar break. 2-bar break. What is a 2-bar break? Well, your stop is moved up here, and if we go over sideways, 1 bar has broken through. If this next bar right here went even lower, that's the stop. It's the second bar, right? It's the second bar. That's where you get out. That's where you close the trade. Does that make sense, guys? Here's your stop. We adjusted here at 0.3. This is the pokey, we call it. We call that the pokey. And the stop is the break of the low of the pokey. Is that clear to everyone? So in black team, we used to say, pokey and then break, and the breaking of the pokey, that's the second bar. So Victoria's saying the other day, I said that we could use the 2-bar break in a pivot if there was a strong support nearby. Otherwise, use 1-bar stop. No, pivot is always 2-bar. The only time that it would be 1-bar is that, let's say here's your stop down here, and then what you get next is a bar that is, at a certain point. So if this is your stop, like, and you get this massive bar that's like, okay, that's like a couple bars, right? So here's a break, and then here's now you start going, all right, this 1 bar is like 3 bars long. Well, by the time it gets into the second bar, you go, this is just wrong, right? You see a clearing bar forming, and it's just getting way beyond, then you go, this is different. This is an igniting move against you. That's a different story, right? Then you just exit. As a matter of fact, when you see that, there are times where I'll just flip the trade there, right? That's a different story. But it only certain circumstances. It has to have the right context, the right position. So 2-bar break. There's only 2 of these stop adjusts that are 2-bar breaks. The other one is going to be ADA May stop adjust. ADA May also is a 2-bar break. All the rest of them, 1-bar break, just 1 penny, right? But this one, it's 2, because a lot of times you will see a pokey and then it continues, and this will keep you out of a lot of stop outs, right? I mean, look at it right here. If you use 2-bar, you will get another dollar move out of this, right? So 15 cents of patience got you another dollar move. See how powerful that is? So, it's easy to make all your attention on just getting out on the first little move here. But if you're able to sit through this, like, you get so many more dollars afterwards. A lot of people will just close the trade here and then they'll miss, $1.50 because they can't, trail these stops. So let's do this exercise, right? Assume you're long here. You get a pullback, right? We got a new high, so you've probably taken some profits here. We got another pullback. And at what point along here, as I move from bar to bar, at what point do we move the stop from here to up here? Guys, tell me at what point. Just type in a 1 if we get to a point where you think that I should move the stop up as I go to the right here. Right, I'm moving, getting to this bar. Yeah, people like here. And then this one is actually, yeah. So I'm going to say right here, because let's call that more or less 75%, right? That's 75%. Now the stop can adjust. Now there's another reason why I would move that sooner and actually have it right here, but we haven't got to time stops yet. At a certain point, I think when we start breaking above this thing, I'm not going to wait all year for it, but time stops are a different thing. Right? So there it is. So keep that in mind. So the second, now we can now move on, right? Can we move on from pivots? Pivots are a very important one because most people get those wrong, and Jan's going to beat up on some of you here with those here when we get to journals, right? All this stuff, when we look at journals, now you're going to understand the language we're using. Now, big bar stop adjust, right? Here's a huge bar. When you see a bunch of other bars, and then you see some bar that just stands off the page and go, there's no, like, this bar should never get erased. When you look at that bar and you say, if this bar gets taken out, like, this whole thing is over, that's when the stop adjusts there. And this is a 1-bar stop adjust. You just go, there's no way that this elephant bar should ever be reversed if we're going to keep this trend going, right? And that definitely happens. So that's a pretty simple one, right? Big bar stop adjusts. There's just some elephant bar that forms in the middle of your trend. Maybe I can find one. Well, let's see what the examples are here, right? So, like, here's a trend with just some nice clearing solid bars. Like this one right here is a nice one, right? That should not be taken out. And here's another one that should just not be taken out. And some trends form like this. A lot of times, if they're opening and igniting right near a moving average, that should never be taken out, right? This one is igniting near a moving average. The ones that I don't think are good stop adjusts, well, this is like above. This is above the moving average, right? This one is shot way up. And so, like, this opened above the, above the moving averages, but a pullback into 50% is still possible. So when, like, it's inside of another move and, like, you haven't had your first pullback yet, I don't like doing that, right? I don't like using a big bar when you haven't had your first pullback yet, because this could move all the way to 50%, which is a totally healthy pullback, and it will have taken out the stop of this, and you're getting stopped out just too soon, right? It shouldn't be the kind of thing that the taking out of that bar still leaves you in a healthy 50% pullback. Latent trend, now it's a good time to use that as a stop adjust, Does that make sense? Just a solid bar stop adjust. And there's probably a bunch of those from today, because today had some nice solid bars going, right? Let's see, what do we have here? Like here's AMD. We're getting late in the trend. This opened right here near the moving average, and you could say that would be a reasonable big bar stop adjust, right? Interestingly, though, it's inside of another move, and I would say the color is also a stop adjust here, which we're going to do next. Interestingly, a lot of these coincide with other things. So if you look at this here, you could say big bar stop adjust, but you've also just, it's right at a pivot, right? So just use the pivot stop adjust. Always give it a little more space, right? I don't like stop adjusting here because it's just making a normal pullback, right? I do think that, like, if you entered down here, though, and you want to protect your gains, I think at this point this is a good one. But again, it's right next to a pivot, so, do you need to do that? I don't know. This is kind of a solid bar here in this downtrend, Maybe you would do that. So late in the trend, you have more options like that, right? Like Oliver says, when you become an aristocrat, then you have more choices, right? Color stop adjust. That's basically just means an RBI GBI. So you took a nice RBI play. You get into your second push, right? You get above your first push. Now the stop can move up to color, right? So that's when you're getting really far in the move, right? That's when you become an aristocrat, right? So your stop can adjust to color when you move into the second push above, in the continuation, right? Interestingly, something we did not explain before when we were talking about ads is that after your ads on your first RBI or GBI, you're allowed to take profits on the second push after an RBI or GBI. And that doesn't matter if you've taken profits yet or not. Does everybody understand that? This is one you don't want to miss. If you have an RBI or GBI, a clear one, you are allowed to take profits on a second push. RBI, GBI almost always give you 2 pushes, but not necessarily 3. So if you have added on one of these, then I would definitely say 2 pushes you're allowed to take profits, right? So here's a color example, right? Got a nice move up. We've got color here, right? We've got a lift off. And now when, when we push away, we got a little bit away here. And now the stop can move up, right? And the criteria is that we have some lift off, right? Right, this is lifted off the moving averages. Here we go. There's an RBI. And now we're getting up above here. We got a solid push. I think this one, we started moving away right here. So this is where we started to get some distance. And now we have a color stop adjust. Does that make sense to people? And you're going to notice that a lot of these things, you could also say at this point, once we get up here, we have a solid bar stop adjust. It's like when we start getting far into the trend, now we start getting closer to bar by bar. You just don't know what's going to form. So this is when you, like, some of them are for the bigger trend, and then some of them are just like, okay, I took my entry here and I'm just getting so profitable now. How do I trail out of this, right? You see that? Like, here's a color stop adjust. Here's a color stop adjust, on the new lows, right? Here's a solid bar stop adjust, right? Then we start getting into new lows right here, and now here's a color stop adjust, and then I'm so far along that I might even say, I don't want to take this one out and just get out there. So, can you see how that can take you a long way down to the bottom using some of these kind of single bar ideas? That's what these are for, is when you're really getting far into the trend. Maybe there's another one here. Right. I mean, here's a color stop adjust. It's like you have a pivot right here. So when we get to 75%, the stop moves from here to here. We get a buy setup forming. We get a red bar ignored. And we start getting a couple pushes away, and now your stop can move from here. Near the new high, it gets to here. And when we get up to here, now the stop can come up to color, right? And then beyond color, now we're getting multiple bars in a row. We can go bar by bar. We're getting distance from the 20, and there's your bar by bar stop. And that's how you sharpen this, right? So you might enter here, you might add here, you might take a new high profit take, you might add on the red bar ignored right here, take some profits, and then you might even take a bar by bar stop right there, because you've kind of got a long leg right here, and you've made some distance, and you've already made whale complete, right? So and that'd be a really good trade, right? And part of how you gauge it is like it doesn't look so huge, but this stock has moved, a few dollars here for you, right? And so it's from 238 to 241. This is a $3 move. So, this isn't maybe a stock that most of you can play, but you're not going to cry about making $3 out of, some of these things. So I just want you to be aware of that. So color stop adjust. Now bar by bar, right? This is when price moves away from the 20. That's what I just said. When price gets away, giving you angle and distance, right? So bar by bar is when, like, here's your moving average. Bar by bar is when, like, here's your moving average, and it's accelerating at a steeper angle, right? This angle is steeper than the moving average, and it's getting distance. That's when bar by bar is most appropriate, right? You guys understand that? Angle and distance. Okay. So that's good to know. All right. If we go back to BA right here, right, I would say we got some angle and distance, right? And consecutive bars moving in a row. So you can close the trade right there. You see that? Let's find another better one. We got some angle and distance on the sell side. So like this one, right? See the distance from the 20? Like this is a long distant move for Facebook. And now it would be totally okay to just close the trade down here, right? Angle and distance. It's falling faster, right? Like this started falling here and this falls even faster, and now bar by bar is appropriate. Some would say right here, right? Whale complete, right? It's totally okay to be done right there. You got your first pullback. This thing's fallen a mile overboard. Some people will hang out. Some will just close the trade right here, and then when they see this at the 20 MA, they'll get back in, right? And again, end up writing it down, right? So let's see if there's any other good ones right here. Yeah, I think this is a good bar by bar, right? And sometimes, like solid bar, like this is a solid bar here, is the same as bar by bar for this, right? So all of this junk is inside this solid green bar, but in a way you're still doing bar by bar, and this failure is a good place to exit, right? But it's gone miles away, hasn't it? Many bars up. This has made a massive move, and you go, okay, it's okay to be out of this one, right? It's gone beyond just trailing the 8 MA and all that sort of thing. It's way up there. Especially when all you get is just consecutive bars. Totally, bar by bar. That's fine right here, right? You can do that. Betty's asking, can I stop completely for the day and not trade after one trade if my stock had a whale completed and it's only 10? Absolutely, Betty. Like, the rest of the day is where it gets hard. If you get a day like this and you enter in QCOM and then you make $4, be done with it. Like, if the market is a breathing mechanism, and the last trading day was a massive inhale, and then basically you wake up on Monday and it just sneezes, like, it gives you all this money, like, be done with it, because you know what happens after that? it inhales again, right? And all the people playing in here are just losing, right? Yeah, and a lot of losses happen. Like that's the hard part is to think that like after you get this massive whale complete that you know there's all sorts of clowns thinking that they're going to make money after here because people were making money here, right? All right, millionaires, and then everybody here is just like they're playing for 10 cents, right? That's ridiculous. So good. I hope that helps, Betty. Like when you get the big exhale, what's coming next? It's very simple. Things just get narrower, and all it does is gobble up your profits. So that's when it's time to stay out. Why do you think we're asking you to look for the narrow Fab 4? What does that mean? What does that mean is coming next, right? It's pretty simple, right? Right, that's the inhale. You want to be there when the exhale happens, right? So bar by bar is simple. 1 penny below, 1 penny above, right? Angle and distance far from the 20. And that's when you can close the whole trade. But let's be doing this after whale complete, right? This is a stop adjustment, which means after whale complete, now we're doing the stop adjustment stuff, right? And I want to be clear, whale complete could be this. Here's the first move, right? Here's the pause, and then this is whale complete. Some whales look like that. Some whales look like this. Pause, this, right? And that's it. That is your whale complete. They don't all look like this, right? Sometimes all you do is just get, continuation like that. Now this was lucky, that sell continued to go down. Some people said, look, I'm rich here. All this got was 1 bar. I'll add again right here, take some profits, and I'll sit through the pullback, right? Here's my stop. Notice how this still triggered, right? If this is your last leg, it's still triggered at the 50%. You go, well, it's 50% of the last move down. It's triggering. Got to play it, right? And then notice the perfect ADMA trail, right? Would get you out right here. So, not all whales are the same. Now, so here, right? Long way. And then finally this one gives you liftoff. And here's your bar by bar stop adjust, right? This is a neat one. You get a long uptrend and then right at the end it says, okay, bar by bar. Pretty simple, right? All right. This is one that catches a lot of people. ADMA stop adjust. Right? You get in. Usually the hard part is figuring out that that's what this is. So you enter here or you add right there, for example. Maybe you entered here. And this is your first add. Maybe you took some whale complete. And then you're noticing that here the ADMA held and here the ADMA held. And if you get that twice in a row and you continue to get not very large bars, just kind of salt and peppery kind of stuff, you realize that this line is what's holding everything. Stop adjust. It's a 2-bar break of the ADMA. Because this is only a 1-bar break and this one here doesn't get through the lows, you're still in it. Now you get a stop adjust to here, and this is where you get out. Does that make sense to people? Nice. That's it. I mean, we've all seen this before, right? It's a 2-bar break. So the bar that breaks through that line is bar number 1, and then you have to wait. The next bar has to break the low of that bar, right? And then later you could have a higher one form somewhere, and that's the end of the move, right? All right. Any questions, or shall I move on? I think we only have like one more of these, and then I can turn you over. Time stop. Sometimes the market starts going sideways. It's not giving you a stop. It's not moving towards your profit take. And it just gives you, 8 to 10 bars going sideways. And, it'll look, let's say you're in a downtrend, right? And then you'll start getting bars like this, that just, your stop was up here before. And you've got 1, 2, 3, 4, 5, 6, 7. You need at least 8. When you get to about 8 bars, you go, you know what? This is its own pivot. And when you realize that you've got about 8 to 10 bars like that, now a 1 penny break, not a pivot stop, which has 2. When you have a time stop, 1 cent above, and you're out, right? That's it. On a 15-minute chart, you probably just have a narrow bar play, right? That's just a narrow bar in a larger time frame. And the trigger of that is where people are buying, or selling. So a time stop is an interesting one that we haven't seen many of lately. I'm not going to do break even yet, but I'm going to see if there are any right here that look like good time stops. Like, I think this is a good time stop right here. See this? So you had a stop here, right? Maybe around this new low, you would bring the stop to this leg. Maybe at this new low, you would bring the stop to this leg, right? And now when it just goes sideways like this, that's a time stop. You guys see that? And notice how it finishes with a clearing bar, and it actually begins a trend moving upwards, right? Pretty cool, right? Like, this thing is just flatlined, right? It's gone from violence to like a slower angle to a pullback. It goes down, and now it just goes right dead on the table, right? Exhale, a little cough, and then this one is just dead on the table, right? That's how that downtrend ended. Does that make sense? I'll bet there were a few of those today. I'll take a peek and see if I can find any. This is one. Oh, this is like the first time we got some good time stops at the end. So short, and if you're just trailing, here's a pivot stop. Here's actually a time stop, right? Because that's more than 8 bars, right? You see that, this whole section here? And it went down again. Maybe this is a, right, solid bar stop. Maybe here's a color stop. Here's another solid bar stop. And then you kind of wait and see what happens. You go, maybe this is going to respond here, right? Why do I keep it up here? Because you don't know. Like, maybe this will take off and go lower, right? But once we get to about 8 bars, we get to about right here, I say, you know what? If it gets above the highs of any of this stuff, I'm out. And then here's the stop for the trend. Does that make sense, guys? You see how the time stop is, it gets you all the way to the end of this whole thing. Because some of you will be down in this mess, in this thing over here, wondering, what do I do? It's not bar by bar, it's not big bar, it's not 8MA, what do I do, right? Well, that's when you use a time stop. You just can't figure out which one it is because it's going sideways. Right? So you will see that. Those do exist. So finally, we got a good example on one of these. I'm going to have to take a screenshot of that and put it into our, put it in to our presentation. Right? And then the last one is the ill-fated break-even stop. There is a time when there's just nothing else left and you got to move your stop to break even. So assume entry here, elephant bar, initial stop, max loss per trade. Here's your third push. We take an initial profit. Here's a red bar ignored. Suppose we add here. And when we start moving beyond this red bar, we go, it's ridiculous to just leave max loss per trade as our stop. It's ridiculous. We need it to be able to sit through a pullback, but I just can't see losing break even at this time. And it's when you've really got nothing else left. I'm going to make this little kind of rule for you. It sort of works. When you're up here, let's say you're up here, and you fill everything in from here up to here, from the low of the day to where you are right now, and you can go back 50%, right? This is the 50% mark, and it's still above your initial entry, then I think it's okay to go to break even, right? Here's your initial entry. This 50% mark is still above your initial entry. Now it's okay to use a break-even stop if there's nothing else you can use. And part of the reason that this is important is this still hasn't even pulled back yet, right? You need to let it have a pullback. But you might say, okay, you can have a pullback, but if 50%, is going to be still like above my initial entry, then we're good. But if we're right here, for example, and here's the low of the day, and 50% would be right here, it's kind of dumb, isn't it, to stop out exactly where this should take off. You guys see that? Like, at this point, for this to pull back 50% is just normal behavior, and getting stopped out of break even would be dumb, right? Later on, though, you start going, okay, 50% is like up here somewhere. There's no way it should get back to break even. Like, that's just giving up a whole day's worth of movement. And I think we can probably come up with one of those from today, right? Like, if we go back to QCOM, the other reason, it's like QCOM is so obviously a bar by bar here that you wouldn't do that anyway. The reason we never use it is usually when you're in that, you're heading towards bar by bar, right? But I can say, here's the high of the day. At this point, I don't want it to be a break-even stop because it can come back to the 20 and it can keep going lower, right? So I don't want to use break-even at that point. But when I get down to about here, and here's the high, and here's 50%, we go, well, it should never hit that, right? And I'm just saying the stop out for all of the trade, right? Like, I would say when we get down here, this should never get back up here, right? Does that make sense, guys? You see that? This is the last one, but that's some time where you would say, okay, we're down here. I don't have a thing I want to use this for, but definitely it should never get back to break even. If it got back to break even, like this thing, if this got at this point when you're down here, if this got back to break even, it's going to keep going to the 200, isn't it? I mean, that's a massive recovery. Like, another way to say it is like, if you get down to here and this ever gets back up to break even, like, isn't that a massive annihilation of the whole day? Like, here's the high. Anything that went back that far, that changes the bias of the whole day, right? It should never get back up here, right? Then you go, okay, I have no other stops to use for the tail end of my trade, but it definitely should not get break even. So, you know, that's a harder one to use. So when you're doing your trade and you've got that piece of paper that has your checklist in front of you, you're going to circle the one that's your correct, your correct, maybe you're down here. Now you circle color, right? Because that green bar, Then you get down further. Now you circle bar by bar as well, and that's what closes your trade, And, I know this one got down here, but I don't think many of us would have made it that far. I think this would get pretty much everybody out. And a few people might re-enter right here. Very few people, but some would say 20 MA, 50% of the last leg, beautiful 180, what the heck? And then they would ride it all the way down to the bottom. And that's like a second trade, pretty much. I don't know, Jan. Do you think you would survive all the way to the bottom here?
No, I would re-enter.
I could see Jan making it to here,
but I would not survive there. No, because that thing has two legs and it's accelerating to the downside, and you can also ask for too much.
Yeah. Exactly. Now, I have this other example here, but I think it's probably best that we get into some of the journals right now. So, because you're going to go through all this with Jan, he's going to be talking about it. So I'm going to turn off my screen share. And it kind of takes a long time to go through all that. I know that we're cutting it a little short today. Is that correct, Paula? I hope that was clear enough. And yeah, no worries. We'll deal with that. And now that we're getting through this section, we're going to be able to.
Okay, thank you, Tyler. Awesome job again. And Paula, don't worry, because you're always working overtime for us, and we're not even paying you for the overtime. So, so I don't think you have to feel bad about anything here. So anyway, sound check, please. I guess the sound check is not really necessary, but okay, just to be sure, let's get started quickly. We have like 15 journals, and that is really a lot. And I don't think we will be able to make it through all those journals today, but just let's see how far we can get. First, I have a question for you all, because I hope you're collecting your 20 trades, looking for the biggest loss. How many trades do you have collected so far? How many trades did you collect so far? Can anybody type in the number? How many trades do you have? 15 for Andrew. Okay, 14, Eric. Enric, 14. Okay, nice. Carlos is on this, I think, on his fifth set and 17 trades. All right, 5 for Ake, 2 and 22 for Dennis. And Okay, 2 sheets. Okay, cool. So that's awesome. So keep doing that, and as soon as you complete a set of 20 trades, pick out that biggest loss trade, make a journal, send it in, and we can try and see if we can help you eliminate your biggest losses. Okay, the reasons for that. So Betty is collecting a book of them. Okay, very nice. You can always plaster them on the wall, Betty. Yeah? So as nice decoration, inspiration. Okay, so let's get started here for today. Volume 1, Betty, that's right, yes. Very good. Here we go. Today, let's start with a trade by Greg. And this is a trade in Uber. Oh, what's happening here? What is happening? I just lost the screen for a second. Oh, it's back. Okay, it's back. It's back. All right. All right. So let's take a look here. So first, he is marking the fabulous 4 here, right? So remember, let's see. No, I'm not really. This here, let's say this is the congestion zone, okay? You might even want to take it from here, but it's probably better to include the low one here as well, okay? So here's your congestion zone, and here's your MA200. So together that does make up a fabulous 4 here. Pretty wide fabulous 4 actually. It's pretty wide, okay? Then let's see what it identifies here. Let me see. There we go. He sees a bottoming tail bar of the rising MA20. Okay, that's a very good observation, but we'll talk about that. Of the rising MA20, there is confirmation here. So he enters above the high of the bar. He is aware of the fact that he is actually trading in the trap zone, meaning below the MA200, right? Under the MA200, right? It says VBS. VBS, yeah, nah, okay, that's something we also need to talk about. Then he's placing a bet. He says this is a wrecking ball concept. This thing is going to break the MA200. Okay, in the trade here, stop is here, event. Okay, so the stop is here, and here's the entry, and then there is no room to add here. It is 2 lots long now. No room to add. Takes profits here. Beautiful profit take. Misses an add here. Okay, I can understand that. Then takes profits again here. Okay. However, trade keeps going. Misses a part here of the trade. And that was the trade. Okay. So, yeah, first of all, so basically, no matter how you look at it, you are entering in the trap zone here, right? That is just, I think it's just not a good idea, because where is the resistance in the trap zone? It's actually exactly here, okay? To be specific, it's actually the MA200 zone here, which is like the strongest resistance support that you will find in your chart. Does anybody know what the MA200 actually represents? Did you ever think about that? What does this really represent, this MA200? Why is it so strong? Yes, of course, it's 200 bars, I get it, but that's not, it's not the last 200 days, Ake, it's the last 200 bars, so 200 times 2 minutes, okay? That's not what I mean. Why is it so strong? Why is it so important? No, I'm not seeing the answer here, no. Not yet. Okay, think about it. It's most watched? No, not even. Look at it. We know that the 20 is an important number, right? Now, if you would look in the time frame, times 10, right? So you have, instead of the 2-minute chart, you look actually in the 20-minute chart. Okay, so you go 10 times higher, and you take the MA20 there from the 20-minute chart. All right. That is actually the same thing as the 200 in the 2-minute chart. Do you guys understand that? Each bar in a 20-minute chart, each bar here takes 20 minutes, right? So that is 10 bars of 2 minutes each. Okay, 10 bars of 2 minutes. So what that means is that basically, if you have 200 bars of 2 minutes, that is the same thing as having 20 bars of 20 minutes. All right. So actually, when you're looking at the MA200 here, what you're really looking at is the MA20 in the 20-minute chart. So, which is roughly the same, of course, as the MA20 in the 15-minute chart. It doesn't really matter that much, but say somewhere in the 15 to 30-minute chart, the MA20 there, that is roughly what this is representing here. Now, do you think that which one is more important, the MA20 in the 15-minute chart or the MA20 in the 2-minute chart? No, Betty, it's not about whether it's the 20-minute chart or the 21-minute chart or I'm just trying to explain to you what the concept is, that the MA200 is representing basically the MA20 in a chart that is 10 times higher. That is what is important here, okay? So whether it's the 20-minute or the 15-minute, it's roughly the same. It doesn't really matter, okay? So now everybody here agrees that the 15-minute chart is more powerful. The MA20 in the 15-minute chart will be more powerful than the MA20 in the 2-minute chart, right? Now guess what? You're looking here roughly at the MA20 in the 15 or 20-minute chart. That's what you're looking at. There it is, okay? That's why it's so strong. That's why it's so important. Is that clear? The relation between the time frames here and how that works out in your moving average? So do you guys understand why it's so powerful? Why is the MA200 so extremely powerful? Well, because of that reason, okay? Because it's really the MA20 in the 15 or the 18 or the 20-minute chart, whatever, somewhere up there on a higher time frame. That is more important. Okay, now that you know that, so Greg, what you're really saying here is that this is enough for you to break the upper area here of the Fab 4, including that MA20 in the 15 minutes. That's really what I think that's really the proper way to think about it. Okay, so I wouldn't be so sure. I mean, it worked here, it worked, but I think you also got lucky here. And I'm not saying that it should bounce here. I don't know, but I think in most cases it will probably have a tough time here to break that resistance. Okay, so I think you should really be careful about that. Now, what happens afterwards here? Look at this. Now it breaks it here. Look, it does break out. See that? You have a big green bar here. What is the name for this bar? How do we call this bar? What would you call this bar? Of course, it's an elephant, but I'd like to hear a little bit more here. It's igniting, definitely. Yeah, it's also clearing, right? It's a clearing, igniting bull elephant bar breaking the MA200 here, okay? So now the situation is different. This is different. Here the market is actually proving to you that it can break the MA200. It's strong enough. You see the difference, Greg? Now the situation is a lot more advantageous, I think, okay? So if you enter here in a long trade, to me that makes much more sense. Here this is really a bit of gambling here, that it will actually break this resistance. And I don't think that on the long term, that's not going to work out. This time it worked, but just to give you a clue, maybe in 7 out of 10 times you will fail here and you will be stopped out. But this was one of those 3 times where it did work. But here you have proof actually that it works. See that? Okay, so all right. So other than that, you did see the ad, you can't do it. Perfect. That's even better. That's fantastic. You saw it and you couldn't do it. That's great. Okay. I mean, seeing it and adding anyway, although you can't do it, would be the wrong thing to do here. So, and I think this profit take is very good because you have here, what is this, guys? What is this? Which animal is this? Tyler just spoke about it. There we go. That's the whale. We have whale complete here, and you're taking profits at the end of that big bar that is breaking out here. That is beautiful. Okay. Then here, well, okay, that is fine because now you are actually away from the MA20 and you're taking profits here. The only thing is that maybe there's a little RBI here. So maybe you would like to wait a little longer, but that doesn't really matter in this case because you're far away in a long rally. I can see that you took profits here on the concept of distance. Okay, let's just say that is okay. One thing I wanted to mention: you're saying here rising MA20, right? Yes and no, because look, normally speaking, the MA20 in the first 10 bars or so, say in this area, is not relevant. It's not relevant because it's the beginning of the day, and what it's really measuring is data from yesterday here, okay? And there is like an opening gap here. The market has not been trading for like 18 hours, and then it opens up. So what really is the meaning of that MA20 at that point? Usually it's very little. However, in this case, there is a difference. There is some meaning to it because there is no real gap here. Okay, there is actually the market is just continuing here. So I can see that you do assign some value to it. Okay, but remember that in many cases, especially when you have gaps, the MA20 is totally irrelevant during the first 10 bars or so. Okay. All right. But good trading overall. Good trading. I think I just made a little mistake in the order of things. Let me find another journal here that I wanted to talk about. Yeah, there it is. There it is. And then we go back to the other one. Because here is actually a similar trade done by Christopher Cruz, who is not here today. He told me he could not be here today. But he published this in the Facebook group as well. And I told him to send it in because I would like to take a look at it. It's the same trade. Look, he basically makes this difference here, right? He identifies the bull elephant bar here, to which Christopher, you should actually add that it's a clearing igniting one. It would be good to write that down, clearing and igniting. Okay. So he enters here above the high. Okay, enters above the high, or actually above the RBI here. Okay. Now the big question is, of course, where is the stop? Because he did not write that. Oh, he did write it. Sorry, no, he does. He says he puts it here in his on the side. The stop is max loss per trade. Okay, and he's 4 lots long here in position plus. Okay, well, we have here our. Oh, sorry, no, that's not true. No, Christopher is not showing us enough data here from yesterday. You see, this is really not enough, Christopher. We don't know what happened before here. There's insufficient information to draw the fabulous 4. And you just saw how Greg did it, and Greg gave a lot more information there. So we can actually decide where is the congestion zone, and then also, of course, where is the MA200, and then we have our fabulous 4. Okay, so he's going 4 lots long, roughly here at 40, right? But his max loss per trade is $90, and he's going long 4 lots. So what does that imply? Well, that implies that $90 divided by 4 is 22, right? So he has like 22 cents on his stop before he hits his max loss per trade. 22 cents, that is roughly at 18. That is somewhere here. Somewhere here, okay? So that is very tight. And it's also a little strange because basically it already means that he should have been stopped out here. And if not there, then definitely here, stopped out. But somehow he manages to stay in the trade. And there's only one explanation for that, which is he did not respect his max loss per trade stop. Okay? Did not respect that. So that is a mortal sin, right? You can't do that because when your stop gets hit here, you blow a huge hole in your account and you're basically done for the day. Okay, this is like Russian roulette. All or nothing. So I wanted to point that out. So 4 lots long is a very bad idea. And anyway, let's go back to the beginning here again. The first thing you have to define here is your initial stop. So suppose you want to go long here, right? You can also go long above this green bar, but you can also go long above the RBI. Where do you place your stop? Where do you place your event stop, guys? You know this. This was discussed in the last session. Where do you place your event stop? Event, yes, but which event? The elephant bar. Yeah, I like that. Yeah, I like that, Betty, because look at the structure of this chart, and that is really the reason why I wanted to have a quick peek at this chart. Okay, there's a couple of things here. First of all, we have this green bar here, right? And what does a green bar like this do to the right? What does it throw to the right? What does it throw to the right? Support, right? So basically we have a big support area here, okay? All right. And then we have also, we have here our MA200, right? That we have just broken out of. More support. And in this case, because we have more or less a continuation on the prices from yesterday, I would say you can also use the MA20 here as a support as well. Okay, throwing support to the upside. Do you see how much support there is in this area? This is incredible. This is like a concrete floor here almost. It's just very unlikely that this is going to be taken out, right? And that is the reason why you want to have your stop here, or even here if you can afford it. You want to be able to use this support to get going here. Okay? Is that clear? Is this understood? So you need to try and train yourself to look at the chart and see these elements and understand where support and resistance is located, and then use it to your advantage. Now, if you're a scared trader, like many of you are, and you see this, you say, oh, I have a great opportunity here. Stop, right? I put my stop here, and I'm going long here. So you're not using any of this information at that point. All you're really looking at is your P&L. You're just scared, and you're trying to snatch a quick profit here, right? That's not going to make you rich. That's for sure. As a matter of fact, it's going to get you stopped out in many, many occasions. So if you see this, think about that. If you see a big green bar before an RBI, stop below the green bar. Much better than stop below the RBI, especially if you have more support like rising MA20s and MA200s there. This is a concrete floor, okay? All right, I wanted to point that out. So Christopher, I was a bit surprised to see that you were still in this trade, because if I calculate your stop here, it was probably somewhere here, and you should have been out here or here, okay? So what you can do here is you should go down here to 2 lots, or maybe even 1 lot. It doesn't matter, as long as you put your stop here. Your stop is the most important thing. First you place your stop, and then you calculate how many lots you can actually afford to buy. Not the other way around. Not like, oh, this is great, I'm going in 4 lots. And then you start thinking, where shall I put the stop? No, this has to be the other way around. Where does my stop go? How many lots can I afford? Okay? All right. So let me move on to the next journal here by Hamsarai. I think he is never with us because he is working at this hour, but he's always watching the recordings. Trading Cisco to is that today? No, that was last week. Okay. So we always start with identifying the Fab4 again, right? Now, this is and roughly over the last hour of data. This is the last hour. Let's take a look here. We have this, right? Okay, this is like the last swings here. So let's say that the Fab4 is roughly here. And in this case, the MA200 is already right in the middle of the congestion zone. So we don't have to change anything. So market opens with a stiff drop here. Okay, it drops really violent with 3 very big red candles. And then Hamzarai identifies here a narrow range bar. Okay. Goes long here with 4 lots and places the stop below the narrow range bar. Okay. Moves up here, pulls back, and takes profit here in this area. What do we call this area here? What is the name? What does Oliver call this area? That's right, Edward. The origin of trouble. This is the origin of trouble. This is the origin from where a strong decline started. Okay, it has to be a strong one, not just anything. It has to be powerful, like here. That's the origin of trouble. Okay, so we have the origin of trouble here. And look, it is actually testing that, and it cannot easily get beyond that. See, it is acting as resistance. So he takes some off here. That's very good. At the same time, moves his stop up here to this level, and then decides to close the trade here. All right. All right. Actually, this is nice trading, but there is a couple of things I need to say about this. First of all, this is not really checklist trading to me, and I'll tell you why. Because basically, with the checklist, we're trying to move to trade basically with the position, right? In most cases. And here we have a very big drop, and then we're going straight against that drop. So what is the likelihood of this market being able to make a new high anytime soon? What are the odds for that? They're very low, right? Akka says 10%. That could very well be, or maybe 20 or so. But anyway, it's very low. So basically, when you're going long here, you already know that the likelihood that we're going to see a new high here is very, very small. Okay. As a matter of fact, what is here? 50%, right? Look at the bounce. See the bounce here? Roughly 50%. That's where it declines. See, there is some resistance around the 50% here. So actually, if you go long against a drop like this, you may want to take some profits here already. Okay? Which is why I'm saying it's not really checklist trading here, because you cannot really even wait for 3 pushes. It's not possible. You're going against the odds here. Okay? This is like a low, you try to make a low risk and make a snowman a very big reward on a small risk. Do you guys understand that that's different from what the checklist is really meant for? So the checklist is not like this golden method that you can apply to any situation all the time. That's not really the way it works, okay? This is more like a scalp style trade, because you're going against all this violence. You're scalping against it, because you cannot expect this thing to go any further than 50% in most cases. 7 or 8 out of 10 times, it will not easily get beyond the 50% here. Okay, so this is also the reason why we do not do scalps here. We're really focused, because scalp is this is like more advanced concept. We're really focusing on the checklist, like going with the flow, trading the big moves. Okay. That is really what the idea is about it. Okay. No, Edward says he should not have submitted this trade this morning. It's almost the same thing. And that's why you're here, Edward, because you needed to realize this. You needed to understand this, right? And this is why I'm explaining it. I want you to see the difference there, understand the big difference between trying to do a scalp trade or going with a checklist trade. Where a checklist trade, the whole idea is that you can really ride out a whale. Right? How can you expect a whale in a situation like this? Well, the answer is you can't. Right? You can't. This is something you need to understand. So going long here, this is good trading, but you're working outside of the checklist. I want you to understand that, because there is no, with the wall like this, the odds for a whale here are low. Not to mention a new high above this point here. Okay. Actually, a whale did occur. See, it did actually happen, but it's in the shadow of this big red wall here. Has to work really, really hard for that. Okay. All right. So this is, I think, is an important thing. I hope you take notes of this, and I would recommend that for the rest of this coaching, at least, that you focus on checklist trades. Okay, try to avoid these kind of trades where you scalp against the power. Do not scalp against the power. That can be great trading when you are advanced and experienced. But what we're trying to focus here is on providing you with the sound foundation of your trading, the basics. Okay, meaning you go with the flow and you try to ride out long moves. That is the plan. And this can never become a long move. Well, it can, but the odds for this becoming a long move up are very, very small, and you need to learn to see that. Okay. All right. So Hamsarai, when you're watching this recording, so actually it's great trading. I can't say anything, but it's quite advanced, and it does not really fit in the checklist. That's all I wanted to say about it. Okay, but great trading otherwise. Just don't do it. Not in this group. All right, we're going to Simon here. Simon is, yes, he's here. Okay, hi Simon. Let's take a look at your Cisco trade. So also Simon, I like this. Simon starts also by identifying here the fabulous 4, right? And then he says my max loss per trade is $100. I'm in position plus, absolutely. Event is elephant bar. His entry is by confirmation, and his stop is event below here. Okay, elephant bar. Yes, Simon. Anything else that you would like to tell us about this bar? It's an elephant bar, absolutely. And what else? What other adjectives can you attach to this bar? What other names come up with it in your mind? Okay, big bar. Yes, well, Victoria is saying it's a clearing bar because look, what it clears is this. It clears the entire area to the left. See that? It just clears it. It just wipes it off the map. It's gone, right? That's very powerful. Plus, second, it's igniting because it really changes whatever happened here is completely changed here. It's an igniting bar that likely starts a new move to the upside. That's what the whole idea behind ignition. That you're trying to look for the start of a new move. Okay, so you have again an igniting, clearing elephant bar here. What else is interesting about this bar? Carlos already says it, and Tony's going to talk about that later today, if I'm not mistaken. That's right. You have an igniting, clearing elephant of the MA200 here, okay? And remember, what was the MA200 again? The MA200 is the MA20 in some higher time frame, like the 15 or the 20 somewhere, high up, right? So you have an incredibly strong event here that is wiping everything off the chart on the strongest location that you can possibly find, okay? So what do you do when you see this? What do you do when you see this? That's right, Simon. Eyes wide open and all in. You give it all you have, right? You just buy as many lots as you can for your max loss per trade, okay? You go all in and you just and you ignore anything else. That's another important thing. You may be looking at 6 or 10 stocks, right? Well, forget about all the others. They become totally irrelevant. When you see this, you start drooling and you just forget about anything else. This is all you see and you go for it, right? Can you be stopped out? Yes, of course. Of course. 1 or 2 times out of 10, you will be stopped out here. But the other 8 times, you will probably make a very big profit, okay? So you just go for it and you accept those 1 or 2 times when it doesn't work, okay? Very powerful, this thing. This should be the top event at location in your trading plan. Whenever you see this, you go for it. Forget about everything. This is all you see. Okay. So, all right. So you're going long here with 2 lots. Yeah. The only thing is you're saying confirmation here. I think Betty already pointed it out. This bar is really, really sizable, right? So it's probably better. Look, if I take off 1/3 of this bar, right? This is still elephant size, right? So this, to me, this is an anticipation entry. You just jump in here at the last, somewhere in the last 30 seconds of the bar. Okay. Yes, you did that right. Yeah, I didn't. You also wrote a second journal. What it could have been. I did not include that, Simon, because we have so many journals that I decided to just focus on this one. Okay. But great that you do that. So Simon actually made 2 journals. One what he did and one what he should have done. Okay, and the should have done has that information in it. He saw that actually this was an anticipation trade. And he noted that in his what I should have done journal. Okay, I recommend that to anyone. Do that, everyone. Just make 2 journals of these kinds of trades when you feel that you underperformed and you should have done better. Okay, 2 lots long here. Stop below. Stop at event here. Okay, we're going. We're pulling back here. Okay, or what seems like a pullback. Is this really a pullback though? Is this really a pullback here? Who says yes? This is a pullback? Who says no, this is not a pullback? Simon says 3 bars. No, no, no. Betty says it's a gift. All right, I agree with that. This is a gift, right? This is not a pullback. You cannot have a pullback after 1 bar. Okay, technically there are 2 bars because there's a little bit of follow through here in the second bar, but this is not what I mean. What I mean is if you have a second bar that looks like this, something, now you have a leg, right? But the leg cannot really consist of 1 bar. That doesn't really make sense, okay? And apart from that, the second problem with this thing is, problem is that basically this is the high here, right? And then we go down 1 bar here and then we move right up. You don't always need 3 bars for a pullback, but it's a good rule of thumb. It's a good rule of thumb to keep in mind that a pullback normally has like 3 bars or more, 3, 4, 5 bars at the minimum. Okay, 2 bars is rarely enough for a pullback. But so this, for 2 reasons, is not a pullback in my book. The first one is that I have only 1 bar here after the high, right? And the second is there is no real lag here. It's just 1 bar. This is a gift. Okay. Does everybody understand the difference between a gift and a pullback? Totally different. Okay. So that also means that actually we have no right here for a profit take. This has some implications. No right to a profit take. And also what we don't have is this, right? The right to move the stop is also not there because we still need to have this area work for us. What was it again with big green bars? What do? Oh yeah, they shoot power to the right. Support here. You want to use this support. If this thing drops later, now it stopped here, right? Look, it went up here, it comes down, it stopped here, but it could also have dipped a little bit more and then take off. You want to use that support. You should not be afraid of these kind of pullbacks. Okay, don't jam that stop up because you're going to be kicked out of trades that are just profitable, that are just going to give you a big win, and you're going to miss out on that. Okay, so this is not a legal stop adjustment, and this is not a legal profit take because we don't have a whale here. We didn't have a pullback. Okay, so we're basically waiting still for 3 pushes. Okay, 3 pushes. Well, we have like 1 push here maybe. Okay, now we have a second attempt here. This is also not really a pullback, but I wouldn't fool you if you call this a pullback because this is, at least this is better. Look, this here is at least better than this one here. See, that's at least better, but it's still not very convincing. But okay, if you see this as a pullback, in that case, you could actually think about a profit take here and move the stop up. If you don't, and this is more like a pullback here. Now we're pulling back. See that? There you go. Or here, even you can add here if you have any ammunition left. And this is a great profit take. Okay? Betty's asking why. The pullback, you mean? You mean why the pull? This pullback is actually going on. Look at the highs from the bars here. Now we're really pulling back, right? See that? We have like 1, 2, 3, 4, 5 bars pullback. But here, well, we have a 2-bar pullback. 2-bar is like not really convincing, but it could be. Okay, but this one is convincing here. This one is better. So the best thing here to do is just to trust the support area, just stay in the trade and wait for it to really take off. Instead of trying to get out as quick as possible and get rid of the risk. Is that clear? Here you have, this is a beautiful pullback. This, mwah. Okay, so beautiful profit take here. Unfortunately, he has only 1 lot left here. Simon has only 1 lot left. How did you go risk-wise here, Simon? Because I think you have like, yeah, you have like $80 risk, right? Okay, so you had only 2 lots. I get it. You could have added that back on, right? You take a profit here. Now you probably felt that this was your pullback. If you find this a pullback, you can add back on right here, right? Or if you find this a pullback, you could add back on here or even here if you wanted to, okay? Because now you're out of ammunition. You cannot ride the trade anymore. What you would do, of course, now you use, after your pivot stop, this is a pivot, right? After the pivot, you go to moving average stop here. Look, here it breaks the MA8 once, right? But we always use a 2-bar stop on the moving average stop. So it's breaking here, not enough. If it would go 1 penny below, we're out, but it doesn't happen. So you stay in the trade. Here again, it comes below, but it does not get any lower, okay? See that? You stay in the trade, and then here it comes below, and then here you're out. Okay? All right. Okay. So I think you can make a 3rd version of your journal, Simon. Okay. Journal number 3. Putting this information in about the pullback, etc. Exactly. Okay. Beautiful. Next one. Oh, wait a minute. I did include it. Okay. Cool. Yeah. I did include it. I thought I left it out, Simon, but I did include your could have been trade. And look, he did see anticipation here. Excellent. Very, very good. Adding here, yes, but only if you have enough risk capital left, of course, because you're working against your MLPT here already. Okay. And of course, this is, as I said, this is definitely not a pullback. This is maybe a pullback, and this is definitely a pullback. Okay. So try to revise that. Great. Let's move on to a trade, another one by Amsarai. Okay, so Amsarai is going here. Let me see. I think this is where the day starts. What's this? Oh, I remember this trade. Oh yeah, that was a nasty one. Yeah, that was a nasty one because you have a fabulous 4 here. Okay, but he's not drawing it correctly. This is the opening bar here, if I recall correctly. This one. So here's your MA 200. And here is your congestion area, right? So this is the fabulous 4. That is the correct way to draw it, okay? So we're breaking out of the Fab 4 here. He sees a bull elephant bar, okay? And goes long, anticipatory. So you should write those things in your journal, I'm sorry. So you write anticipatory, okay? anticipatory entry here, and then stop here below, and he gets stopped out here. Does anybody see a mistake here? Good trade or bad trade? Good trade or bad trade? Good trade. Yep. Right. Betty says max loss per trade better. No. We'll get to that. But in this case, Betty, there's a question about that. I think by Greg, and we'll talk about that in a minute. However, you're far away from the MA200 here. So there's no need for a max loss per trade stop as per the plan. The plan does not require it. Okay. So it's perfectly okay to use an event stop here. Okay. Yeah, I see nothing wrong with this trade. This is a great trade. It just didn't work. And that happens all the time. Okay. Dennis says good stop out for sideways indecision. What do you mean? You mean you wanted to get out here somewhere? Or do you mean he got out at the right point, Dennis? Exactly, it's the right stop. Why is this the right stop? There's a crucial thing in this chart that I already talked about before that also tells you that is the only right place to be stopped out of this trade. What was that again? What is in this chart that tells you my stop has to remain there and I have to trust support? Yep, right, Hendrik. Support from the bull elephant bar. There we go. See it? Support. Does that always work? No, of course not. But in most cases, it will work. Okay? In most cases, it will work. Look at the similarity with the other chart that I pointed out. That was the trade in Uber that we spoke about. That was posted by Christopher. And I think also by, was it Greg? It was you, Greg, right? Similarity here. Big green bar. And also, look, MA20 rising here, right? So you have a combination of support up and support to the right. Okay? So you need to use that. And if it doesn't work, well, okay, you get stopped out. That's right. But in 7 or 8 out of 10 times, it will work. And as you saw in Uber, there you were kicked out of a trade. If you didn't use it, you will be kicked out of a trade that was really running like crazy, right? And you can cry all day about that because you're left with a loss probably. And the trade is just taking off and you're no longer in. Okay? Now here that didn't work, but excellent trading here. Try to really pay attention to those big bars. As soon as you see a big bar, think support to the right, or a big red bar, resistance to the right. Okay? And look for synergy with rising MA20s or MA200s, etc. Very powerful concept. All right, and here we are. I just already said it. Greg sent this in. He says, it's a very good question. According to the checklist, our choice of max loss per trade versus event stop is based on a single parameter, which is distance, or maybe even proximity to the 200 MA. At the same time, we know that wide trap zones provide less formidable support resistance and allow deeper penetration of the adverse price movement. So his question is, why do we ignore price information inside the trap zone when we choose the stop loss level, while we can use, say, pivots inside the trap zone as some guidance? Okay. I don't mean to question your authority. No, of course not. I understand. Yeah, right. So you have an example here. In MU here. Before anything, let me just comment, Greg, that look, all of this here is irrelevant, right? So you're really 2/3 of your journal is filled with irrelevant data that are meaningless to the trade. Okay, that's one of my my hobbies to always point that out. So I just keep doing that. I'm sorry. Then you have your Fab 4 here. Okay, that's good. And you say it's a wide Fab 4. And what you're saying basically is that you short it here, okay? Shorting here below the bottoming tail bar, or actually in the bottoming tail bar, anticipatory. And the stop is event. Why is it event? Well, because you say I'm not very far from the MA2. I'm not very close to the MA200, so I should use an event stop. That's right. So you get stopped out here, and then the trade goes. You are thinking about a re-entry, and you didn't do it. And then the question is really, was this the right stop? I totally get it. Let me just explain why the rule says MA200 at, max loss per trade whenever your event stop is close to the MA200. That is the rule because that is the way we want to get you we want you to get started. Okay, you need a simple rule here that also works with your with your buying power, the amount of risk that you can take on your account. Okay. Yes, you can definitely here put your stop here. That is actually a brilliant idea. I totally agree with that because I think that's where this came from, right? That's a brilliant idea because you just give it that extra here to the last pivot, and also you have the MA200 above you, and you allow this trade to actually bounce in here. It will likely at least go down maybe 50%, enough for you to get out of the trade, a break even, whatever. That's great. The only thing is, can you afford this? You see, so in the beginning, what we need you to do is just keep it simple. Look at the MA200 and take those decisions. Once you have that mastered, you can, of course, start to use max loss per trade in other situations as well, where you think it is to your benefit. And Gregory, I think you identified a great example here where you could really do that, provided, of course, that you can afford it. Okay, so if you're going short here, you're roughly at 70, right? And if you put your stop here, well, we're roughly at 50 or so, right? So now we have 80 cents here, 80 cents. And your max loss per trade is $80. So that means that you could just afford one lot. See? You see where I'm coming from? So now it's starting to become difficult because now you have the problem here that, in fact, you identified a great location for the stop, but the problem is you cannot really afford it because your account size is too small to really do anything here. You end up with one lot in the trade. Okay, so however you want to trade this, you can do it. You can do anything you want as long as you have a good motivation for it. Okay, so in this case, if you say, look, the simple checklist says that because we are away from the MA200, I should use an event stop. However, I want to overrule that because I want to give my trade a little bit more room. I'm going for max loss per trade, and I'm going for one lot only because I think that's a better thing to do here. That is great. If you do that, that's fantastic. Okay. So I hope that is an answer to your question that helps you to progress here. Okay. Edward is saying, would the better play be to enter with one lot and then add when red takes out green on the pivot? You mean here? Yeah, in hindsight, yes. In hindsight, yes, Edward. The problem is we don't know this before it happens, right? Like say he really likes to play but can't afford it. Yeah, well, he can afford the play if he puts a stop here. It becomes difficult to afford the play if he puts a stop here. Which choice is better? You tell me. You tell me. Neither one is really nice, okay? Because with the tighter stop, you know that the likelihood of being stopped out for no good reason is bigger. And with the wider stop, you cannot really trade really well because you start with only one lot. And you don't know what happens. Maybe it just goes down immediately and you're in there with one lot, right? So it's, in hindsight, it's always easy, but the problem is you don't know what's going to happen here, and you have to really make a choice between two alternatives, and neither one of them is optimal. Okay? Right. Okay, so Carla in the Spanish room. Carla sent us a trade. And I like this. She's already pointing out $90 max loss per trade, so we know where we are. And she says also 30 cents per lot, meaning if you have 30 cents risk, she can use 3 lots here on this trade. Okay? Let's take a look. Cisco. So the trap zone here. So we have the MA200 and we have the congestion zone. This, excuse me, this one is easy, right? So she marks that really well and then says, I buy here one lot. Okay, event bull 180. All right, bull 180, or if you want to be a little more sophisticated, you could call it an RBTO, right? RBTO, red bar takeout, meaning we have one red bar, and instead of a bull 180 takes it out at once, we have 2 or 3 or 4 bars before it's taken out. That's called a red bar takeout, okay? Basically the same thing in a different variation. So going 2 lots long here on confirmation, meaning above the red bar, okay? And the stop event. Stop event here, and then selling here, selling here. Okay, first about the stop. Is this the correct stop here, Carla? According to the checklist? She says yes. I say no. Yes, of course, it was your stop, I know. But is this the correct stop location? Or did you make a mistake here? What does the checklist tell you to do? And why? Okay, I'll help you out. We're close to the MA200 here, right? See that? Your event stop is very close to the MA200, which is a zone. And so the question is, why would you want to be stopped out near the MA200? Don't. So what you need to do whenever your event stop is close to the MA200, you need to use a max loss per trade stop. You have to push that stop down somewhere below the MA200. And that you do by using this max loss per trade stop. Okay? That is what the checklist tells you to do. Whenever your event stop is very close to the MA200, use a max loss per trade stop instead, okay? So that is one thing here. Let's take a quick look. How much is your risk in this trade? I think you got, oh, you say it here. You got in at 50, right? And your stop is now 32. Look. So basically you have 20 cents here times 2. You're using $40 risk here with your event stop, which is incorrect, okay? Suppose you still go 2 lots long here and you use your max loss per trade stop. That means that you allow for 45 cents, right? So 90 cents max loss per trade, 2 lots, is 45 cents below your entry. So that is roughly here. See that? There's your max loss per trade stop. See that, Carla? So that would be great. You could actually afford it. You could afford it. So using a max loss per trade, you place your stop on the other side of the MA200 and you allow this whole area here to help you out in case the idea is when this stock drops first, it will likely bounce here, okay? And you don't want to kill the trade here just at the moment that the market is trying to help you. Do you understand it, Carla? Is this clear? Exactly. You give room to the stock in this particular situation where this MA200 is so close, where in other words where the MA20 in the 15-minute or the 20-minute or whatever time frame up there is so close, that powerful support. Okay, all right. Second thing, so today you did not know this yet because Tyler had not yet been able to present checklist part 2, but today we have learned that our first profit take is after 3 pushes, right? 3 pushes. So if you get in here, you have like 1, 2, 3 pushes. So basically your first profit take is here. All right? It's here, actually, where you get out of the trade. See, your profit take is too early. The profit take is too soon. And that is a big problem, because what that means is that if you win here, you win very small, right? You don't milk the trade. You don't get out of the trade what you should be getting out of the trade. And you will not make enough money to make back the losses for the trades where you get stopped out. Okay? So it's important to follow that rule and to actually make sure that you get that you wait for 3 pushes here. Okay, so the first profit take is roughly here, and then you also close the last lot. This is a rule that we haven't really talked about. I don't think it was really presented as part of the checklist, but it's a very good one that Oliver is always telling everybody. Never close your last lot. Okay, the last lot in your trade, always trail it out. Always use stop adjustments till the moment that finally you get stopped out. Well, look what that would do here for you this time, right? So you're long here, and here's your first profit take. Okay, first profit take. Now, at some point here, let's say at this point, roughly, somewhere here, what kind of trend would you call this? What do you see here? What is this chart showing you here? Exactly, it's a power trend. Correct, power trend. And what do we do in a power trend? What kind of stop do we use in a power trend again? Tyler explained it today. If we have a power trend, what stop method do we use? Carla's saying bar by bar or moving average. No, that's not correct, Carla. Bar by bar, we don't use. We use only the moving average stop, and normally moving average 8 stop. Okay, which you have a lot of lines in here, which is probably it's the green one. Okay, I see it. There it is, the green one here. Okay, not bar by bar. In a power trend, you should never use bar by bar, because a power trend goes up and down often, and you will easily be stopped out with no good reason. So you need to use a moving average. Now look, so at some point here you say, oh look, this is a power trend, beautiful. Now you start trailing here, right? Start trailing here. 2-bar stop. Here we get below the MA8. So now if we get 1 penny below, you're out. But we do not get 1 penny below, it just goes on again. Here again, see this one? 1 penny below, you're out. It doesn't happen. It just goes on here again. Here again, it tests the MA8. 1 penny below here. This time, you're being stopped out. So your second lot gets stopped out here, and your first profit take should be roughly here. Okay? It's quite a different trade, Carla, isn't it? Big profits here. So this is a great example, I think, of how the checklist can actually help you to really get the best from your trade. Okay, so try to practice following that plan that the checklist presents to you, and try to write out these trades, because this is where the checklist really excels. Okay, all right. So quickly, oh, we already did this one. This was the one by Christopher. Okay, and then we have one here from Carlos. Let's see, do we still have time? No, I don't think so. I think I have to stop here, guys, and hand over to Tony. So Tony has another, 15 minutes or so, and then Paula has a break before she goes to the next translation. Will you still have any voice left tonight, Paula? Because you must have been talking all day, doing the boss session, now doing the coaching, and then doing another session. Wow, impressive! I'm really impressed. I could never do that. I could never do that. Oh, the 7-day seminar next week as well. Okay. Yeah. Fine. Okay, so Tony, it's your turn. You can grab the screen if you want. Well, let me close out here.
Sound check. 1, 2, 3, 4, 5. See if I get my screen up. Oh, there it is. Oh, there it is. All right. It's a nice Monday. I'm a little hangover from Mother's Day festivals yesterday. So we gotta go fast. Here we go. This is how the markets look today. The Dow gapped up. Gives you a nice green bullish bar. Rolls over a little. Goes up again. Now it's coming down. The NASDAQ took a dive, right? Gap down. Gives you a bearish elephant bar. Plus. Goes sideways. Drops down some more. It's trying to come back up. And it's coming back down. So it's very weak. S&P 500. Kind of sideways. Drops. Gives you a bull 180. Comes back to prior day's close. Topping tails. Rolls over. It's coming down. And you see on the heat map. It's almost diagonally, right? Technology's down. These financials are down. Semi-chips are down. Communications down. But then you have the banks up. Right? Drug companies are up. The oil and gas is up. Beverages, utilities, basic materials. So almost split down the middle there, right? Very interesting how that works out. Oops, I forgot to do something here. Okay. I'm going to talk about the power surge. Should be your number one play to look out for. Because when it happens, it's a great high odds probability play. Okay, the 200 moving average. This is I know repetition for a lot of you. For some of you, it could be new. But I like to repeat things and go over things and learn things. I was in many of Oliver's classes over and over. And it definitely helped me to sink in the information into my brain. Okay, the mighty 200 moving average. All right, most of us know about it, right? Flatness is king, right? It's used as support. It's used as resistance. It's used as a magnet. The price gets attracted to the 200 moving average zone back and forth, right? So repetition is what creates mastery of your skills. That's what we're going over. The 200 moving average support. See, here's the 200 moving average zone. The price drops down to this 200 moving average and then goes back up. The tails touch it, it goes back up. Drops back down to it, goes back up. And this one's resistance. Touches it and comes back down. Here's another one with resistance. Here's the flat 200 moving average. The mighty flat 200 moving average. Price goes up, touches it, top and tail, drops down. The 20 moving average goes back up to the 200 moving average zone and drops back down. Goes sideways, touches it with a tail, sideways. Stays in this channel. It keeps touching the 200 moving average, but it doesn't break through it, right? So it's really good resistance in this area. Pulls back down, goes back up, hits the 200 and drops. Here's another one. Flat 200 moving average. Price comes up. 3 tails near the 200 moving average zone, drops back down. 3 wicks, I should say, not tails, wicks. Then over here you have a couple more bars touching it and drops back down. Another one. So it's really good resistance on that play. So what is Oliver's number one favorite play? Power surge originating off the 200 moving average. So you got very high probabilities of it working 80% of the time. So this is another tool for your toolbox. These power surges off the 200 moving average are powerful. High odds, high probability it's going to work. So keep your eyes out for those and go in appropriately what's the right size for you. You know, 1 lot, 2 lots, 3 lots, whatever it may be. Oops. So here we have 2 major areas of support. That puts the odds in your favor. You got the 200 moving average, big power bar of support, right? This thing wipes out everything to the left, a clearing bull elephant bar. So in this one, this power surge here takes out the opening bar. There was a topping tail here. You can't see too well in this picture though. Takes out the red bar and basically took out the Fab 4, right? So you had this bull elephant bar surging up and then power surging continues. Follow through all the way up, right? That's a powerful play. Here's another example of QCOM. These are older charts. Here's a 200 moving average on the bottom. And then you have a power surge. So this is like Oliver's number one play. You pile in, right? With all the lots that are available to you, you can go in 1 lot, 2 lots, 3 lots, and power surge your way up for profits. Here's JD, another example. Power surge originating off the 200 moving. Here's the 200 moving average going downwards here. And it's a zone. Remember, it's a zone and it's not a line. So in this zone, this power surge takes off, right? You pile in here and go. This is a key play. Yeah, follow through, high probabilities, high odds. So you want to probably put medium size lots in, or maybe heavy, depends on your skill level. Here's an old picture of NVIDIA. The 200 moving average is actually going diagonally 45-degree angle up here. Then you have this power surge right out the 200, right? The zone, the 200 zone. And it's taking out the red bars, clearing everything here. Clears the Fab 4, has follow through, and just goes power surge up. That's when you get into money manager and start layering out up here. Here's a lower price stock. I missed the price on it. Sorry about that. I cut it out. But here's a power surge off the 200. Right? Follows through. Goes a little pullback. Then rides the A train up. That's what you want to see. So if you have the IFT 50, you can sort it by price and then just go down the list. So you'd have stocks that are more in your price range where you're able to trade them with more lot size if they're lower price. Sometimes you can combine the bars in your mind. Like here is off the 200 moving average. You can combine these to give you a nice power surge, right? Clears everything to the left and just goes up. Has followed through with a ribby to here and then stops. Doesn't have a lot. It pulls back to the 20 and then goes up again. So these are different scenarios you're going to see. They're not always going to be picture perfect. So you got to be ready for whatever the market throws at you, right? Origin of the run was down here at bull 180, right? It's usually a good sign when the origin is with a nice pattern to work off of. So here's a bear power surge, right? You're shorting this and it goes down. Has a nice follow through. 2 pushes and you're out, right? Made nice profits there. Here's combining bars again. This one's actually combining from yesterday, right? From the previous day. I mean, yeah, this bar and these bars give you a nice power surge off the 200. Goes sideways, rides the 8 train up. A ribby keeps going. So that's a nice little power surge. All right. So you have a bear 180 power surge on the 200 moving average, right? So they're not always going to be picture perfect. So you have to use your imagination, use your mind how this is working out here. Gives you a Gibby and keeps going down. This one had a nice run down, see? So you combine bars off the 200 zone here. Combine this. Has a little pause here and continues up, followed through, right? So I'm showing you different scenarios because they're not always going to be picture perfect. These were a couple of my trades at one time. I got Zoom, right? Narrow fat forward. Look at that. Power surge off the 200 moving edge. Pile in, man. You see my entries on the 1 minute chart here. Right? It's going up the 8 train, riding the 8 train up. Gives you a little pullback. I'm fat with profits, so I start layering out. I'm layering out. Layering out. Poof, finally I'm up here, right? So that was like maybe a $5 run, you know, $4 run, whatever it was. That was a nice one. Here's Zoom again. Oops, went too fast. Okay. Power surge off the 200 right here. Has followed through, but then it comes right back to the 200 moving average. So I'm using it as support, right? So I added on the way up, but on the way back, I added as well because I was using this as support. If this thing continues on down, I have to get out. Take the L and I'm out, you know? Take a small L and get out. But instead, it rides an 8 train up the track, and I'm riding it, riding around. Poof. If you notice on the one, I got out almost where some of my original entries were, but fat with profits, right? Because I brought down my average price. So I made a few bucks on this one. It was a little more of a challenge. they're not always going to be perfect scenario set up for you. So you got to play with what they throw at you. So this one has multiple power surges off the 200. Over here you have a bear elephant bar coming down, but then it goes bullish, and you have a bull elephant bar off the 200. Hit these top and tail all the way back to the 200 again, and it gives you another bull elephant bar with a little follow through. This one goes sideways and drops right through the 200. It gives you a bull 180, right, far from the 20. So it kind of goes back up to the 20 and rolls over and dies. Over here we have another bull 180 off the 200 moving average. All right, has follow through, goes sideways up and out. Here's another bull 180 off the zone, 200 zone. Here's a true bull 180, right? 2-to-1 win ratio, far from the 20 moving average. This is the origin of this run. Makes it a nice one. There's a bull A, but no 2-to-1 win ratio, so. But it seems to have worked. Those are lower odds. Here's a power surge with 2 pushes and you're out, right? You have to be flexible. If that's all it's going to give you, you're out. This was a $19 stock. You know it's not going to keep running a whole bunch more. So it gave you 2 pushes and you get out. So here we have power surge down, right? Neutral bar and bear elephant bars, sideways and down. Neutral bars, sideways, down. Here you get your bear elephant bar off the 200. But you're in the trap zone, so that's not a good one, but it worked. Here's a power surge off the 200. All right, narrow fab 4, follow through, keeps going up, 2-3 pushes. Well, it's been great. All right, that was Oliver's number 1 play. Practice a power surge to develop your skills and be profitable. Practice those power surges. Very high probability of working 80% of the time. And you gotta practice them a lot. Repetitions what creates mastery of your skills. So let me show you a few that popped up this morning. Here's MU, right? Yeah, a lot of them.
Sorry to interrupt, Tony.
Yes?
Tony? Sorry to interrupt, but Paula has to start in 5 minutes translating somewhere else.
Okay. So that was,
I think we
that
have
was
to cut
plenty
it
of
short
examples. Okay, no problem. These
So
are
let's
just plenty of examples.
Let's make sure you get some more time next session. And I thank everybody for being here with us today. And we'll see each other on Wednesday at 12 noon, okay? And yeah, Wednesday 12 noon. Send in those journals. Send in those journals so we have something to discuss. See you then. Bye.